So the question is, what should you be doing as a homeowner? What should you be doing as a borrower? And the answer to that is, according to a new report from Scotiabank, the Bank of Canada is about to get crushed by the Federal Reserve. As the policies between the two central banks deviate, with the Bank of Canada taking a pause from raising interest rates, while the Federal Reserve in the US presses on the gas and continues to increase interest rates in order to make sure that they continue to do the job with respect to killing inflation. And this report comes from Chief Economist Derek Holt, who was one of the most hawkish economists when it came to interest rate increases in early 2022. In fact, I myself thought that his forecasts were way too high, and it turns out his forecasts were actually too low. But he has consistently been the economist with respect to interest rates who has called things most accurately. So when he speaks, this is one of those times where I'm inclined to listen. But before I get into all the details of why this is such a huge problem with the Bank of Canada stopping their interest rate increases and the Federal Reserve continuing, my name is Noel Mathias, and if you want to thrive financially, this is the place for you. So go ahead, click that subscribe button and hit that like button so more people like you can see this video. And don't forget, you can still get my new book, Mortgage Secrets, by going to mortgagesecrets.ca for absolutely free. All you have to do is pay the shipping and handling. Okay, so let's jump in and discuss the Federal Reserve, the Bank of Canada, and why the Federal Reserve continuing to increase interest rates could be a problem for the Canadian economy. I'm going to start by showing you first and foremost the headline here. Bank of Canada risks falling too far behind the Fed, Scotia says. So obviously the Bank of Canada has taken the position that they are going to pause with respect to their interest rate increases to see if the work that they've already done is going to have an impact on the economy and to assess whether further increases need to be done. Meanwhile, the Federal Reserve in the US is continuing to increase interest rates out of fears that largely stem from the 1970s and the 1980s, and those fears are that they haven't done enough. So the Fed is taking the position that they're going to absolutely do everything they can to crush inflation to make sure those 1970s and 1980s scenarios where they had massive inflation don't occur again. The Bank of Canada is taking the position of a wait-and-see approach. Now, why is this such a potential problem? Well, when the Bank of Canada deviates from the Federal Reserve in the US, it has significant implications on our currency. So investment dollars tend to go to places where investment returns are going to be higher. So if the Federal Reserve has a higher interest rate than the Bank of Canada, well, there's more of a tendency for investment dollars to go to the US rather than to Canada. So as the Federal Reserve continues to increase interest rates, that means that the US dollar is going to get a currency bump while the Canadian dollar is going to weaken. And a weakening Canadian dollar has several implications. So first and foremost, it will make our exports less expensive for other countries. Now, you may think that's a good thing from a growth perspective, and it is, because our goods will become cheaper for other countries to buy, meaning that the exporting sectors of our economy will do well. However, that will have an inflationary effect, as too will the fact that anything that we try to import will become more expensive. So retailers who bring in goods from other countries are going to have to spend more Canadian dollars in order to bring them in, and subsequently that will also have an inflationary effect. So anytime the US interest rates get higher than Canadian interest rates, it's going to create further inflationary pressure in Canada. Now, in the Scotiabank report, they point out several times where this has happened in the past, where the Bank of Canada has deviated from the Federal Reserve in the US. However, in most of those scenarios, inflation was also deviating as well. But as of this moment, inflation in the US and inflation in Canada is fairly comparable, which makes the two central banks deviating on their interest rate policies more problematic. And as you can see from comparing chart 1 to chart 2 here, anytime that the policy rates have deviated substantially, there's almost always been a major difference between the core inflation rates. And these are the rates that exclude energy and food. Now, that leads us into why the Bank of Canada and the Fed are deviating. And that's largely, believe it or not, due to housing and what's happening in the Canadian housing market. And the primary problem here is that debt loads in Canada are exceedingly high, and interest rate increases in Canada have significantly more sensitivity with respect to debt than those same changes that happened in the US. And the reason for this is because of the differences between Canadian and American mortgages. American mortgages tend to have 15 and 30-year rates, which means interest rates are guaranteed for extended periods of time, versus in Canada, where almost all rates are short-term rates, and this includes the 5-year fixed mortgages. So when the Bank of Canada increases interest rates, mortgage holders feel those interest rate increases significantly faster than our American counterparts. And for anybody who had a variable rate or an adjustable rate mortgage, which is a pretty significant amount of Canadians, they are already feeling the pain. And anybody who has a fixed rate mortgage who hasn't felt it already is about to in the next 1 or 2 years. Because as mortgages come up for renewal, they're going to have significantly higher payments pretty much overnight. So in an article on February 7th, Tiff Macklem came out and said specifically that homeowner debt helped spur the pause in interest rate increases in Canada. Because quite honestly, we were about to face a pretty serious problem if the Bank of Canada continued to increase interest rates. And that problem is the fact that many mortgages would have exceeded the stress test rates that most Canadian borrowers had been qualifying at. So it was clearly prudent that the Bank of Canada take this pause in order to see how those changes in interest rates affect the people who have variable rate and adjustable rate debt, and subsequently how that affects the economy overall. Now, that's not to say that we're out of the woods here. Likely the biggest risk for the Canadian economy and for interest rates is the fact that the Canadian dollar could weaken. And if it weakens further, the Bank of Canada could find themselves in a position where they have no other choice but to increase interest rates, again, because of the inflationary pressures that come along with a weakened dollar. So while we're in a position where we're having a pause on interest rates, there is a very high likelihood that we could see higher rates come fall, or even worse, early in the summer or late spring. And it all comes down to the numbers. It comes down to the inflationary numbers. It comes down to the currency values. And overall, this is a very, very, very tough balancing act for the Bank of Canada to get right. So the question is, what should you be doing as a homeowner? What should you be doing as a borrower? And the answer to that is minimizing your debt risk. So first and foremost, we're seeing a lot of fixed rate mortgages that are priced significantly lower than what people are paying on their variable rates. This might be a good time to consider locking in. Now, there are some people out here that are saying that we're at the peak of interest rates and it's a bad time to lock in. But the reality is we just don't know what's going to happen. And our big brothers to the south here have a pretty significant part to play in where our interest rates go. Now, I'm not saying everybody should lock in. I am a believer that people who choose variable rate mortgages do so for specific reasons. And you need to make sure that your mortgage strategy fits what your next 3 to 5 years look like. But in addition to potentially locking in and lowering your interest rate increased risk, and by the way, I wouldn't recommend locking into a 5-year fix with a big bank, primarily because of how big their penalties are. If you are going to lock in, maybe shop around for a mortgage that won't have as big of penalties as the big banks have on their 5-year fixed mortgages. In addition to reducing your interest rate risk, I'd also recommend looking at the other debts that you have, because the people who have the highest risk are those people who have the most debt. So eliminating credit card debt, eliminating car loans, even though you're going to have to give up your fancy vehicle in order to do so, and eliminating line of credit debt is probably the single best thing you can do to reduce your risk financially. And on top of all that, if you can take advantage of the hot job market, get a better job, maybe a higher paying job, or go to your current employer and negotiate a higher wage rate, all of those things will help you position yourself for the future, regardless of if the Bank of Canada has to follow the US and increase interest rates, or if they're able to stay the course. But the number one thing that you can do is focus on the things that you have control of, your debt, your wage, and all of the things that go along with your buying choices and whatnot, instead of focusing on the potential bad news that could come out of the Fed or the Bank of Canada at any given time. Because the unfortunate thing about the media is that if it bleeds, it leads, and you have to be aware of that. It's designed to scare you in order to get you to read, and often when you do read, it just creates unnecessary financial stress that you would be far better off by avoiding. Oh, and if you are looking to lock in your rates, make sure you check out this video right here, which talks about the rates at the best lenders in Canada, which are the ones that don't have those high big bank penalties.